Hi, folks. This is Sean Hyman, and I wanted to talk to you about one place over the last year or two where money has been flowing that is not on a lot of people's radars right now, and that's the emerging markets. And I'm looking at an ETF symbol EEM, which is the iShares MSCI Emerging Markets ETF. Just a quick look at its holdings over at Yahoo Finance. You can see that it's heavy in financial services, consumer cyclical, and technology. It's got a fairly low PE of 12.1, whereas a lot of the U.S. market has a PE overall of, depending on whether you're talking about the NASDAQ or S&P 500 or other big indices, uh, anywhere from about 24 to 26 on the PE there. So it's about, you know, the EEM is about half the PE, so is about twice the value of what the overall average market is right now in here in the U.S. And then if you look at top 10 holdings, while they are foreign companies, they're big companies. Many of you would know some of the names of some like Samsung, Taiwan Semiconductor, Alibaba. Uh, some of you would know Baidu. Others of you might know China Mobile or China Construction Bank, etc. So there's a number of things you can look at there by going to finance.yahoo.com and just putting in the symbol EEM. And I'm in the holdings section, which breaks down a lot of that type stuff for you. So EEM is PE wise is a value. Remember, I've talked about how money will have to go from institutional money will have to shift from an overvalued market to undervalued assets, and so I believe they've been doing that over the last couple of years, selling the rallies in the U.S. stock market, but they have to put that money to work somewhere. And the thing that's been responding over the last couple of years is, or I say last couple of years, about the last year and a half, has been the emerging markets. So, but here's why they aren't on anybody's radar yet, hardly, because back in the '08 crash, emerging markets tanked hard, and then they recovered, but then they just kind of went in this sideways range. So for a number of years, emerging markets really haven't been trending higher overall. They've just been kind of treading water. Well, treading water doesn't pick up headlines and get people excited and things of that sort, but they eventually kick out of that. And so those of you who have been longtime subscribers with me in other newsletters, you know that I teach that long sideways ranges beget long strong trends. And the practical reason is for that is because while price hovers and just hangs out for a while, the earnings of these companies has time to go up and head higher, which makes the PEs cheaper. And so the PEs get compressed over time as the price pretty much does nothing, but the earnings of these companies continue to improve. And then the PEs get so cheap that they start attracting capital, and it busts them out of the range, and they can trend for quite some time because it takes them a while to go from a low PE to a high PE. So that's the nuts and bolts behind why long sideways ranges beget long strong trends. Also, you hear me talk a lot about ABC corrections and ABC crashes and things like that. This was an ABC crash downtrend right here. A, B, C. C tends to be longer, and it tends to have 5 waves within it. 1, 2, 3, 4, 5. So that bottomed here, and then it rallied back up, and then had a 3-wave correction lower, A, B, C, and those tend to have 5 waves lower than C wave, 1, 2, 3, 4, 5. So they can't have 3 waves, but many times they have 5. So there's the ultimate bottom there. Here's your long-term bottom. Here's your most near-term bottom or medium-term bottom. So with this being, whether this would be a bigger A, B, C, or a 1, 2, 3, 4, 5, either way, there's a huge chance that the next long-term move is upward and breaks EEM above this 43 to 44 or so range that it's been stuck in for the last so many years. And so the price is approaching this 43 to 44 range once again. And again, when it does it, when something's been in motion for a while, market participants just get conditioned and numb to the fact that they expect it, what is and has happened, to continue to, to be happening in the future. But the savvy person looks for patterns and fundamental changes and different things like that that could cause a different scenario. And after all this time, there's a huge chance that we're in the breakout period. One, most sideways ranges tend to only last for 3 to 5 years anyway. And so here you've had it for 1, 2, 3, 4, 5, 5 to 6 years in this range. So there's a huge chance statistically that it breaks out just off of what we normally see with how long ranges tend to last. And there's some that do last longer, but not many. And again, it goes back to because earnings, continue to grow while the price hangs out and the PEs get so compressed. That means that stock is so cheap relative to the earnings level that it becomes so enticing to investors that they start piling into the sector, and it breaks it out and to head higher. We've also seen a golden cross here with the 50-week moving average coming above the 200-week. We know that prices have been moving up for the last year and a half. The MACD continues to improve. RSI continues to improve. Now, granted, the price is a good ways away from either one of these moving averages, so at a certain point it would not surprise me to see somewhat of a pullback anywhere between halfway to where these moving averages are to all the way back to them. But I'm looking for one of the future pushes higher to finally break above this 43 to 44 area. Once it does, I believe you're going to see the news media outlets and different ones hopping on board, talking about the rally in emerging markets once we get notably above this 43 to 44 area. So once it gets closer to 50 is probably when they're going to be picking up on it. But I want to let you know about it ahead of time, because emerging markets, looking at the daily chart, they've been trending higher all year. They're at or near 52-week highs, so we know the money and everything is going there. But looking at the longer term, which you always want to also take the longer term, bigger picture view too, because just looking at the near term, what happens over the last year is like taking your nose and putting it up against the center of a big screen TV. You can see a little bit around you, and even that gets kind of blurry, but you can't see the whole picture. But if you take 10 or 20 steps back from that picture, you see a different scenario, and you start to see the whole picture come. Your focus comes back in, and also you see what was in your peripheral that you couldn't see now becomes clear, and you can clearly see. So you tend to want to look at least minimally 5 years back, but I look usually a good decade back. Also look to find a major decisive low. If I can't find that, I'll go back on the charts until I can. That way I know where the last downtrend ended and the next uptrend began. So this is likely a wave 1, 2, and then in 3 right now, which 3 and 5 tend to be the biggest. So I'm looking for a huge breakout there. But even if this is A, B, and then C, which I don't think that it is, there still should be more waves to come within this, because this is only really 1, 2, 3. And so we should see more extension of that than 4 and 5. So that would push this from, probably 41 to 50 or higher, just off of that alone, provided that it does break above this. So fundamentally, it's cheap. Institutional money could definitely go to it. Emerging markets have been kind of dead in the water for a number of years, and in time, what is seemingly dead comes alive, and the masses want to hammer on what has been alive for a long time, because they can't see a day where that would ever change. But really, once that's been happening for a very long time, and that's what we've been seeing in the overall stock market, when you've got the S&P 500 that's been on this tear from early 09 till now, and you've got 5 waves up in an uptrend already, 1, 2, 3, 4, and then now 5, and we're well into that 5th wave, with probably 1, 2, 3, 4, and in the 5th of 5th right now. So it's the most dangerous time to be in the markets. It's where there's the most extreme optimism in the market. So it seems like you're the nut job for coming out of the markets when everybody else is in them, and they can't see a day where it would be any different, because it seems like every day when they turn on the TV, they're talking about an up market. But when it gets very far extended away from its 200-week moving average, there's the danger of massive correction. And then when they get so overvalued, like it was back here, fundamentally, you actually have a downtrend that not only goes back to the major moving average, but then ends up going collapsing below it and sometimes way below it. And that's what I believe we'll have on the next round here, because we've already had 5 waves up. So the next thing is a 3-wave downtrend, which would be something like what we see here. So we could easily see the S&P 500 in time over the next year or 2 or 3 go from the 2400s here back down to minimally the 6 to 1800s, I would say, but you could even see something more extreme like 12 to 1400s very easily. So, and the people that think that that can't happen, you just need to go back and look at longer term charts to look at the last 2 major bear markets. The S&P 500 went from 1553 to 768 before it stopped. So that over more than cut in half. The next one, so that was 2000 to later on into 2002, so that was a couple year decline. 1576 here in 2007 when it peaked out, middle of 2007, down to 666. Not the best of number, but so this was 666, a lot less. I mean, almost 1,000-point drop off of a 1576 index. So that's a huge move as well, lower, and that took from mid 2007 to earlier part of 2009, so probably a year and a half downtrend there. So when this starts, see, and here's the deal: when this was happening, you couldn't pay people to believe, that you couldn't even get them to fathom that this could happen. When this happened, you just couldn't get them to believe that this could happen. And they're just so bullish in the final stages here of the rally. They can't see nor believe nor even want to believe that this could even happen, and they think you're the idiot for exiting and even contemplating the thought process that this could happen, but yet it does. And same thing here. So by the way, here was a major 3-wave correction lower. So here's an ABC. In this case, A was longer, which is rare. Here's an ABC, which C was longer, which is common, and then a larger ABC here, and then a major bottom, and then we got 5 waves up here. So we've come from 666 to 2453 from 2009 till now, and I'm looking for the next move like this or this to unfold. It may or may not be quite as great as that. My opinion is that it will be as great as that, because there's more people on leverage now at these levels than there ever were here or here. And the extreme optimism is there just as much as it was here or here. And this has been going for longer than this one lasted, and for at least as long as this one lasted, if not longer. So there's all the more reason for the public to think, well, this has been going for this long. Why should it stop? Why should it change? Because again, the amateurs thinks what is happening and what has happened is destined to continue to happen, whereas the pro is always assessing, and they're looking for fundamental changes, technical changes, etc., and dangers along the way. And the dangers right now are the fundamental, the PE ratio on the S&P 500 and NASDAQ are at crash levels of what the market crashed at in 2000 and 1929 and some other market crashes. Also, the price is so far away from the 200-week moving average. We've basically got a sell signal on the MACD, and the RSI is heading lower and still overbought. So the market here is very risky, and pros know it. So where are they likely to move money? To a market that has half the PE. And again, emerging markets had gotten in a bubble from the early 2000s to 2007 and 8, and then that bubble popped and crashed. Remember, when a move moves parabolic, much like you're seeing happen in Bitcoin right now, Amazon stock, Netflix, Google, a number of these stocks, and also Bitcoin, that's the move you're seeing, and this is what's coming. And a lot of people don't believe it, because they can't imagine when this is happening that this could ever happen. But here's your three-wave crash right here, ABC, and EEM went from 46 to 15s before it stopped. So who would have thought? Well, now it recovered, and again, after bubbles, it takes many years to kind of find the footing for the next leg higher. Well, now it came back up, and then it's been consolidating a good bit. And here was your big three-wave major move, and then here's your more minor three-wave move here. So this is likely your next major bottom here. And once we take out these 43s to 44s, because this 46 was just such a temporary spike, most of that there was 43.80 also. So you top 44s, you get into 45 plus, and you'll likely see this take back off again. And there's been literally a decade that the emerging market earnings have had to head higher, which gives the justification for why this could break out and head higher. So because it peaked in 2007, and here we are in 2017, so this was a dead decade for emerging markets. Unless you had the nerve to buy in down here, if you bought anywhere in here, the investors have just been frustrated because it's just gone sideways. So all the more reason why we're ready for the next leg up in emerging markets. And in my opinion, for most people, it is better not to try to cherry pick an emerging market stock to say this will be the winner. It's usually better to go with stocks like, an ETF, exchange traded fund like EEM, that covers emerging market stocks that are huge and that are domiciled in many different countries and sectors, etc. So it's a bigger, broader move, and you're not having to pick the stock that's going to be the winner, and you don't have to be an emerging market stock expert, etc. Because those are more volatile stocks and can generally be higher risk. But when they're at a PE of 12, like they are now, that's one of the better times to be in them. Now that's not to say that today is the day to buy that. This is not a buy sell recommendation. It's an observation, because my buy sell recommendations will be in the premium membership section, and that's coming in the coming weeks to months. And so that'll all be set up, and I'll have a live portfolio of buy and sell recommendations and things like that, just like you're used to in my previous newsletters. But this is something to be aware of. Again, you wouldn't want to buy this until it came back down closer to the moving averages if you did buy it. So in this case, it's in like the 37s on the weekly charts, and then let's go back and look and see what it is on the daily. Yeah, you're in the 37s before you get close to the 200-day moving average as well. So anywhere from 37 to 39, somewhere in there is a lot better area to own this than in the 41s or 2s that it's been at here recently. But anyway, so again, just an observation. It's a place where I think money is flowing and will continue to flow. We'll get more confirmation of that once we see it top the 44s or so, and to sustain itself above that. But anyway, for now, keep an eye on EEM and the emerging markets, and I'm looking for them to be one of the next places where some of the money rolls out of the overall U.S. stock market and into emerging markets. Okay, thanks so much for watching, and God bless. Bye-bye.